Here's a sobering statistic. 20% of new businesses fail in their first year, 50% don't make it to year 5, and 65% are gone within 10 years. But here's what most people don't tell you. Most of these failures are preventable. They don't fail because of bad ideas. They fail because of bad processes and bad decisions, missed risks, gaps in knowledge, mistakes that could have been avoided with the right guidance at the right time. And that's exactly why this channel exists. So today, let's talk about how I'm going to potentially save you thousands of dollars and months of headaches in the next 25 minutes. As a former chief risk officer at a global financial institution and entrepreneur, I've watched smart, talented business owners make the same 7 mistakes over and over again. These mistakes cost them money, they cost them time, and in some cases, they cost them their entire business. But every mistake is preventable. But here's the good news. Every single one is potentially avoidable. Let's get started. Hey, I'm Scott Lindsay. Welcome to the Small Business Risk Channel. For over 30 years, I served as Chief Risk Officer, Chief Compliance Officer, and CFO of a publicly traded bank. I've also founded and grown my own internet solutions company that served 85 financial institutions and hundreds of thousands individual household customers across much of the United States. I've seen business mistakes from both sides of the table, the billion-dollar corporate side and the bootstrap startup side, and I'm here to help entrepreneurs avoid the most costly ones. Subscribe for weekly strategies. If you're serious about building a business that lasts, do me a favor right now. Hit that subscribe button below this video and click the notification bell so you never miss a new upload. I am going to release a new video every single week with practical strategies you can use immediately. And if you find value in this video, hit that like button. It helps the YouTube algorithm show this content to more entrepreneurs who need it. All right, so let's dive into the 7 critical mistakes. Mistake number 1, mixing personal and business finances. This is the most common mistake I see among entrepreneurs, and it can destroy your business protection in seconds. Here's what happens. Someone incorporates federally or provincially, or they register as a sole proprietor. They think they're set up. Then they use their personal bank account for business expenses to keep things simple. They pay themselves randomly without documentation. They sign contracts in their personal name instead of the business name. And when they get sued, a lawyer discovers all of this. The court can pierce the corporate veil. That means your incorporation is legally meaningless. Your personal assets, your house, your car, your RRSP are all now at risk in the lawsuit. Let's talk about a small business owner in Ontario. Let's call her Maria. She had incorporated her consulting business, but she'd been using her personal checking account at her local bank for everything because it was easier than managing 2 accounts. A client sued her claiming she'd given bad advice. During discovery, the opposing attorney found out she'd never maintained separation between personal and business accounts. The judge ruled that her corporation was essentially a sham, and the liability was directed toward Maria personally and not protected by the corporate veil. Her personal home was suddenly exposed in that lawsuit. She eventually settled for $75,000, money that came directly from her personal savings. All this happened because she wanted to save the hassle of maintaining 2 bank accounts. Here's how you avoid this mistake. First, open a separate business bank account immediately. Most major Canadian banks, RBC, TD Bank, Scotiabank, BMO, CIBC, all offer business accounts. This is non-negotiable. Every business transaction goes through that account. Period. Second, get a business credit card. Use it exclusively for business expenses. Never mix it with personal spending. Many cards offer cash back on business expenses, which helps with cash flow. Third, pay yourself properly. If you're incorporated, you can take a salary or dividends, but document everything. If you're a sole proprietor, track your draws. Never just transfer money randomly. Fourth, sign all contracts, invoices, and agreements in your business name. If you're incorporated, include Inc. or Incorporated or Limited. If you're operating as a trade name, make sure it's properly registered. Fifth, Keep immaculate records. Business expenses in one place. Personal expenses should be separate. Clean books make clean legal protection. Plus, CRA loves clean books during an audit. Your corporation or business registration is a legal wall protecting your personal assets, but you have to maintain that wall. Don't tear it down to save 30 minutes of bookkeeping each month. Mistake number 2, wrong business structure. Choosing the wrong business structure for Canadian tax and legal purposes. In Canada, you have several options: sole proprietorship, partnership, federal corporation, provincial corporation. The choice matters more than most people realize. A lot of entrepreneurs start as sole proprietors because it's easy. Just register your business name with your province, get a business number from CRA, and you're off. No incorporation fees. But here's the problem. As a sole proprietor, you have zero liability protection. If someone sues your business, they're suing you personally, your house, your car, your RRSP, your TFSA. Everything is on the table. Plus, sole proprietors pay tax at your personal marginal rate, which in provinces like Ontario or Quebec can be over 50% once you're making good money. Incorporation gives you liability protection and potential tax advantages, but you have to decide between federal and provincial incorporation. Federal incorporation protects your business name across all of Canada. It costs more upfront, around $200 plus legal fees, but if you plan to operate nationally, it's worth it. Provincial incorporation varies by province but is cheaper, usually around $300 to $500 all in. Your name is protected in your province. If you're only doing business in one province, this often makes sense. Here's the tax advantage of incorporation. Canadian-controlled private corporations get the small business deduction. You pay only 9 to 11.5% corporate tax on the first $500,000 of active business income, depending on your province. That's a huge saving compared to personal rates. You can leave money in the corporation, invest it, and only pay personal tax when you take dividends. It's a powerful tax deferral strategy. Here's my recommendation for Canadian entrepreneurs. If you're just testing an idea, making less than $30,000 a year, sole proprietorship is fine. Keep it simple, but always check with your tax advisor or accountant to make sure you are well positioned for your circumstance. Once you're making real revenue, $30,000 to $50,000 plus, incorporate. The tax savings and liability protection become worth the extra paperwork. Talk to a CPA or accountant who specializes in Canadian small business. They'll help you structure it right and maximize your tax efficiency. Get good advice. And whatever you do, don't forget to file your annual returns with Corporations Canada or your provincial registry. Missing deadlines can cost you your good standing and your liability protection. Mistake number 3, ignoring GST, HST, and provincial sales tax requirements. This is uniquely Canadian and it trips up new business owners constantly. Here's the rule. If your business makes more than $30,000 in revenue in any 4 consecutive calendar quarters, you must register for GST or HST. It's not optional. It is required. I've seen entrepreneurs hit 40, 50, 60,000 in revenue and think they don't need to worry about it yet. Then CRA catches up with them. You owe back GST or HST on all that revenue, plus penalties and interest. There was a contractor in Alberta who hit $80,000 in revenue his first year, never registered for GST. 18 months later, CRA sent him a letter. He owed $4,000 in GST plus $1,200 in penalties and interest. Money he didn't have because he'd never collected it from his customers. If you're in Ontario, Nova Scotia, New Brunswick, Newfoundland and Labrador, or Prince Edward Island, you charge HST. That's the Harmonized Sales Tax. It combines federal and provincial. If you're in British Columbia, Saskatchewan, or Manitoba, you charge GST. That's 5% federal. Some of these provinces also have PST, Provincial Sales Tax, which is separate. If you're in Alberta, you only charge GST, 5%, no provincial sales tax. If you're in Quebec, you charge GST plus QST, Quebec Sales Tax, 2 separate registrations. Here's the good news. Once you're registered, you can claim input tax credits. That means you get back the GST or HST you pay on business expenses, software, equipment, supplies, all of it. This actually helps your cash flow once you're set up properly. Here's my advice. Get your tax person involved. Even if you're under $30,000, consider registering voluntarily. Why? Because it makes you look more professional and legitimate to clients, and you can claim those input tax credits immediately. Set up your GST or HST account through the CRA My Business account. It's free, takes about 30 minutes, then charge it on your invoices and remit it quarterly or annually depending on your revenue. Don't make the mistake of treating collected sales tax as your money. It's not. It belongs to CRA. Keep it in a separate account and remit it on time. CRA does not mess around with sales tax non-compliance. Mistake number 4, underestimating startup costs. Massively underestimating startup costs and cash flow needs in the Canadian market. New business owners think about the obvious costs, maybe equipment, maybe inventory, maybe a website, but they forget about the hidden costs that drain cash fast in Canada. Always err on the safe side. Overestimate the funds needed to start up the business. Let me give you a real example. A man named Tom in Ottawa started a landscaping business. He calculated he needed $12,000. Equipment, truck, initial marketing. He thought he had it covered. Provincial business registration, $60 in Ontario. Federal incorporation, $200. Legal fees to set it up properly, $1,000. WSIB or Workplace Safety and Insurance Board coverage, $1,500 annually. General liability insurance, $2,500 per year. Commercial vehicle insurance, $3,000 per year. Accounting software, $40 per month. Website hosting and domain, $250. Business cards and initial marketing materials, $500. Professional association memberships, $400. And here's the killer. He didn't have any revenue for the first 2 months while he built his client base. He still had personal bills to pay, rent, food, car payment. His $12,000 estimate was actually more like $25,000 when you factored in everything plus 3 months of living expenses. He ran out of money in month 4 and had to take on a part-time job to keep the business alive. Here's how you avoid this. 1. Make a complete startup cost list. And I mean complete. Business registration, legal fees, insurance, including WSIB if you have employees, licenses and permits, equipment, initial inventory, website, marketing, accounting software, banking fees. Canadian banks charge monthly fees for business accounts, usually $15 to $30 per month. Add it all up. 2. Add a cash flow buffer. Calculate 3 to 6 months of operating expenses plus your personal living expenses. You need runway. 3. Understand your payment terms. In Canada, net 30 is common. That means you deliver work today, you might not get paid for 30 days, or 60 days for government contracts. Can you survive that gap? 4. Build in a 25% contingency. Things always cost more than you think. 5. Consider Canadian small business financing options. BDC, Business Development Bank of Canada, offers startup loans. Many provinces have small business grants. Look into Futurepreneur Canada if you're under 40. Don't launch undercapitalized. It's one of the top reasons Canadian businesses fail in year 1. Mistake number 5, misunderstanding employment law. Completely misunderstanding Canadian employment and labor standards. This mistake gets expensive fast. Canadian employment law is different from the U.S. We have stronger employee protections. Employment standards vary by province, and the consequences of getting it wrong are severe. Here is a real-world example. A business owner in BC who hired his first employee didn't put together an employment contract, just a handshake and a promise of $40,000 per year. 6 months later, the relationship wasn't working. He let the employee go with 2 weeks' notice, thinking that was generous. The employee sued for wrongful dismissal. Under BC employment standards and common law, she was entitled to reasonable notice. The court awarded her 3 months' pay plus benefits, $8,000 he hadn't budgeted. Here's what Canadian business owners need to know. First, each province has employment standards legislation, minimum wage, overtime rules, vacation pay, statutory holidays, termination notice requirements. They're all different by province. In Ontario, employees get 2 weeks vacation after 1 year. In Saskatchewan, it's 3 weeks after 1 year. Know your province's rules. Second, common law. Reasonable notice is often more generous than minimum standards. If you terminate someone without cause, they may be entitled to 1 month per year of service in many cases. That's why you need proper employment contracts with clear termination clauses. Third, understand the difference between employees and independent contractors. CRA has strict rules. If you misclassify someone, you could owe back CPP, EI, and income tax withholdings. Fourth, when you hire your first employee, you need to register for payroll with CRA. Deduct income tax, CPP, and EI. Remit it monthly or quarterly. File T4 slips by the end of February. Fifth, you may need WSIB coverage. In Ontario, most businesses with employees need it. In BC, it's called WorkSafe BC. In Alberta, WCB. This is non-optional. Penalties are severe if you skip it. Here's my strong recommendation. Before you hire your first employee, talk to an employment lawyer in your province. Get a proper employment contract template. Understand your obligations. It costs $500 to $1,000 up front, but it can save you tens of thousands in wrongful dismissal claims later. Canadian employment law favors employees. Protect yourself. Mistake number 6. Insurance gaps. Skipping business insurance. Thinking you don't need business insurance or buying the wrong coverage. A lot of Canadian entrepreneurs skip insurance to save money. Huge mistake. Real-world example, a graphic designer in Toronto who was working from home. She figured she didn't need insurance. She was just one person with a laptop. What could go wrong? Then a client claimed her design work infringed on another company's trademark. They sued her client. Her client sued her for indemnification. The claim was for $50,000. She had no errors and omissions insurance. She had to hire a lawyer out of pocket. Defense costs alone were $12,000. She eventually settled for $15,000. Her business never recovered. Here's what Canadian business owners need. Commercial general liability. Commercial general liability insurance. This covers bodily injury and property damage. If a client trips in your office, you're covered. If you damage client property, you're covered. In Canada, $1 to $2 million in coverage typically costs $1,000 to $3,000 per year depending on your industry. 2. Professional liability, E&O. Professional liability insurance, also called errors and omissions. If you provide advice or services, you need this. Consultants, accountants, designers, developers, coaches, all need E&O coverage. This covers claims that your work caused financial loss. 3. Cyber liability. Cyber liability insurance. If you store client data, credit card information, personal information, you need cyber coverage. A data breach can cost tens of thousands in notification costs, legal fees, and fines under PIPEDA or provincial privacy laws. 4. Business interruption insurance. If your business can't operate due to fire, flood, or other disaster, this replaces lost income while you rebuild. 5. Commercial property. Commercial property insurance if you have an office, equipment, or inventory. 6. Key person insurance. Key person insurance. If your business depends on you or one other person, this provides cash to the business if that person dies or becomes disabled. Here's what I recommend. Talk to a commercial insurance broker, not just an agent tied to one company. A broker can shop multiple Canadian insurers like Intact, Aviva, Economical, and find you the best coverage for your situation. Get 3 quotes, compare coverage. Get quotes from 3 brokers. Compare coverage, not just price. The cheapest policy might have exclusions that leave you exposed. And review your insurance annually. As your business grows and changes, your risks change. Insurance feels like a waste until you need it, and then it saves your business. Mistake number 7, Canadian tax confusion. Mistake number 7, completely failing to understand Canadian tax obligations for small businesses. The most expensive mistakes. Canadian tax is complex. Federal tax through CRA, provincial tax, GST or HST, payroll remittances if you have employees, corporate tax if you're incorporated, personal tax on business income. And the penalties for getting it wrong are brutal. Real-world example. Let me tell you about Sarah in Manitoba. She started a successful e-commerce business. First year, she made $90,000 in profit. She was a sole proprietor, so all that income flowed to her personal tax return. She didn't make quarterly tax installments because she didn't know she had to. When tax time came, she owed $28,000 in federal and provincial tax, plus interest and penalties for not making installments, another $3,000. She hadn't saved any of it. She'd spent the cash on growing the business. She ended up on a CRA payment plan paying interest monthly. Here's what every Canadian business owner needs to know. Sole proprietor taxes. If you're a sole proprietor, your business income is reported on your T1 personal tax return. You pay tax at your marginal rate. In some provinces, that can be 45 to 53% once you're making good money. If you owe more than $3,000 in tax for the year, CRA requires quarterly installments the following year: March, June, September, and December. If you don't pay them, you pay interest. If you're incorporated, your corporation files a T2 corporate tax return. You pay corporate tax on profits. Currently 9 to 11.5% on the first $500,000 for small businesses. When you take money out as salary, you pay personal tax. When you take dividends, you pay tax at dividend rates, which are lower but not deductible to the corporation. You need to work with an accountant to optimize this. If you have employees, you remit payroll deductions monthly or quarterly, income tax, CPP, EI. You also pay the employer portion of CPP and EI. Budget for this. It's about 7% on top of wages. Remember, you file T4 slips by the end of February for the previous year. Here are my tax recommendations. The first one is the most important. 1. Hire a Canadian accountant or CPA who specializes in small business, not just for year-end, for planning throughout the year. 2. Set aside 30 to 40% of your profit for taxes. Keep it in a separate savings account. Don't touch it. 3. Make quarterly installments if required. Better to overpay and get a refund than underpay and owe interest. 4. Keep immaculate records. Save every receipt. Track every expense. Use accounting software like QuickBooks designed for Canadian businesses. 5. Know your deductions. Home office expenses if you work from home. Vehicle expenses if you use your car for business. Meals and entertainment at 50%. Professional development. Marketing. 6. If you're incorporated, pay yourself a reasonable salary. CRA watches for corporations that pay no salary and only dividends. It can trigger an audit. 7. File on time. Corporate taxes are due 6 months after year end, but you pay tax within 3 months. Personal taxes are due April 30th or June 15th if you're self-employed. Tax is the biggest expense in your business. Manage it proactively, not reactively. All right, let's recap the 7 critical mistakes many new business owners in Canada make. 1. Mixing personal and business finances. 2. Choosing the wrong business structure. 3. Ignoring GST, HST, and sales tax requirements. 4. Underestimating startup costs and cash flow needs. 5. Misunderstanding Canadian employment law. 6. Skipping business insurance. 7. Failing to understand Canadian tax obligations. Every single one of these mistakes is preventable, and now you know exactly how to avoid them. Here's what I want you to do right now. Pick one of these 7 mistakes, the one that hit closest to home for you, and commit to fixing it this week. Open that separate business bank account. Talk to an accountant about incorporating. Register for GST if you need to. Call an insurance broker. Whatever it is, take one action this week. If you found this valuable, do me a huge favor. First, smash that like button right now. It tells YouTube to show this video to more Canadian entrepreneurs who need this information. Second, if you haven't subscribed yet, hit that subscribe button and turn on the notification bell. I release a new video every single week with strategies that can save you thousands of dollars and months of headaches. And drop a comment below and tell me which of these 7 mistakes you've made or almost made. I will read every single comment, and your questions help me create better content that actually serves you. Next week, I'm releasing another video aimed at helping you minimize the risks in starting a new business in Canada from day one. You absolutely do not want to miss this video. It's going to save you so much time and confusion. Remember, you don't need luck to build a successful business in Canada. You need knowledge. You need clarity. You need the right guidance at the right time.